Have you ever had that feeling where the market seems great, it's luring you in, but you just feel like you're about to get stuck? Well, you're definitely not alone. Today, we're going to break down a really interesting strategy for avoiding what our source material calls the flower trap, a way to invest when everything feels like a total gamble.
And this quote right here, it just nails the feeling perfectly. You're making moves, you're seeing some small gains, but you have this nagging sense that you're just getting stuck. The market looks so attractive, like a beautiful flower, but it's got this sticky trap waiting inside. And by the time you realize what's happening, it might just be too late to get out. So that leads us right to the big question, right? If the market feels this shaky, this precarious, what's the smart move? How are you supposed to protect your money while still trying to make it grow? Well, that's exactly the puzzle this strategy is designed to solve. Okay, before we jump into the solution, we've got to understand the problem. Why all the caution in the first place? Well, the source points to some massive, economy-level warning signs that suggest now is probably not the time for blind optimism.
First up is this number, $6.6 trillion. That's how big the Federal Reserve's balance sheet is right now. Now, to give you some context, before 2020, it was only $4 trillion. When you pump that much extra money into the system, it can seriously inflate the price of assets, creating what the source argues is a really artificial and unstable market foundation.
And then there's this monster of a number, the official national debt, sitting at a pretty staggering $37.6 trillion. A debt that large, according to the source, creates this underlying fragility in the economy, another layer of risk that investors really need to be thinking about. And that all leads to this other powerful idea from the source. The argument is that the recent market rallies, they've been happening on very low volume. So what does that even mean? It suggests that the amount of money actually propping up these high prices is way less than it seems, turning the whole thing into what they call a house of cards.
All right, so that's a pretty concerning backdrop. What's the plan? What's the solution? It's a simple but really powerful philosophy that boils down to three little words. Be the house. Let's dig into what that actually means.
The absolute key to being the house is understanding this term, options premium. See, when you sell an options contract, you're basically selling an insurance policy on a stock. Someone pays you a fee, that's the premium, for the right to buy or sell that stock at a set price later on. And the best part? You collect that cash right up front, no matter what happens next. So here's where the mindset shifts. Most investors, whether they know it or not, are playing the role of the gambler. They're placing bets on which way the market is going to go. The Be the House strategy flips that completely. You become the casino. You profit from probabilities by collecting all those small payments from the gamblers, whether their individual bets win or lose.
Okay, so how do you actually put this into practice? I mean, it's not just about selling options all over the place. It's a very structured system that's designed to do something the author calls hedging your hedges.
The whole system is built around two portfolios that work together, kind of like a team. First, you have your long-term portfolio, or LTP. That's where you keep your core stocks, the ones you believe in for growth. And then you have the short-term portfolio, the STP. Think of this as the engine room. It's used to generate income and, crucially, to protect your main portfolio. They're designed to balance each other out. And this is the engine that drives the whole strategy. It's a simple four-step cycle. 1, you own great stocks for the long haul. 2, you buy insurance or hedges to protect those stocks from a crash. 3, you sell options premium to generate cash. And 4, this is the magic part, you use that cash you just generated to pay for the insurance. It's a completely self-funding loop. So, what's the end game here? What's the ultimate goal of running this cycle over and over? It's right here, creating perpetually free insurance. The whole idea is to generate more cash from selling those little insurance policies than you spend on protecting your main portfolio. And if you can do that, you are essentially protecting your biggest assets for free. Okay, so theory is one thing, but how does this all translate into actual results? What does the payoff look like in the real world? Well, this is where the strategy really transforms from a defensive move into a powerful income-generating engine.
Let's look at some real numbers from the source. In just 1 month, the short-term portfolio, that's the income and hedging part, was up 11%. And over a 4-month period, the long-term portfolio, the growth part, was up over 62%. This is a great snapshot of how both parts of the system are designed to work together.
And now for the really big number.
By applying this strategy systematically, the source material calculates an estimated gross income of over $500,000 every single quarter. That's purely from selling options premium. Now look, obviously this is based on a very large portfolio, but it shows you the sheer power of the cash flow this be-the-house engine can generate.
So how is a number like that even possible? It's not about one single lucky trade, it's a formula really, and it comes down to two key things. First, you're consistently selling premium on a diversified group of stocks, so you're spreading your risk. And second, you just have to win more often than you lose, which, if you're the house, is exactly what you're set up to do over time.
This quote right here gets to the absolute core of why this strategy has a statistical edge. Time is on your side. Why? Because the premium you collect, that little fee, it decays a little bit every single day. Most options contracts end up expiring worthless, which means you just get to keep the entire premium. That time decay is the secret sauce, the built-in advantage that puts the odds in your favor.
So we'll leave you with this final thought to chew on. This whole strategy is really a fundamental shift in thinking. Instead of trying to guess what's going to happen next week or next month, what if you could build a portfolio that profits from the one thing we know is certain, that time will pass and that premium will decay? It's a pretty fascinating way to think about navigating a market that feels to so many people like a trap.